Hit me with that 9.5% yield, baby. Hey, what's up, you guys? Welcome back. So today we're talking about RioCan, which is Canada's second largest real estate investment trust. And now I know what you're gonna say. Dude, you only bought 10 shares? What the heck? That's so little. Well, first of all, I'm not made of money like half of you, so I only buy stocks in very small chunks. Now, the reason why I do this is so that I can average into a stock. Now, if I bought a stock all at once, then if the stock crashes, then I don't have any cash left over and I'd be kind of screwed. Yeah, so I'm not one of those guys that just throw like thousands of dollars into a stock at once. And I mean, it depends on how big your portfolio is, right? But for my needs, I think that's the strategy that I've chosen, which is just to ease into it. But keep in mind that I already had 100 shares of RioCan before this, so I only bought 10 shares, and I did it more as even a demonstration purpose. I mean, it was a red day today, so that's why I bought. If it was a massive green day, I probably wouldn't have bought. But yeah, I just kind of did it for demonstration purposes as well, just to show you the app that I use, which is Wealthsimple Trade, and how easy it is just to buy stocks using it. I'm not sponsored by Wealthsimple, by the way. I genuinely use Wealthsimple Trade as one of my primary brokerage firms, and I just love the service and I love the design of the app. I just think that they do so much of a better job than, let's say, a CIBC or RBC, and their mobile experience is just so much better. So if you're in Canada and you're looking for a brokerage, Wealthsimple might be a great choice for you. But anyways, let's move on. So the reason why I'm talking about RioCan is that I think that RioCan is the ultimate dividend investor's dream. So just to recap, RioCan is a real estate investment trust, or REIT. So it's actually not like a typical stock. Now, the difference between a REIT and a typical stock is that I think REITs have some sort of regulation where they have to pay out a certain percentage of their earnings as dividends. So the primary purpose of a REIT is to pay out the dividend, versus with a regular stock, the primary purpose could be growth, right? So if you invest in, let's say, an Uber or Tesla, they'll probably never pay out dividends, or at least if they pay out dividends, it will be like decades down the line. And I'm not expecting Tesla to pay out dividends anytime soon, just because they're investing all their money back into the business to grow it. Versus the purpose of a REIT is more to reward the shareholders, because when you own real estate, then you just get to sit there and collect the payments from the tenants. But anyways, the reason why I'm interested in RioCan is that they're actually the second largest REIT in Canada, and they primarily focus on commercial real estate. So whenever you go to like a shopping plaza or just any type of grocery store or retail location, a lot of the times the land is not owned by the grocery store themselves. They lease the land from big landlords like RioCan. Now there's another one called Choice Properties, which is Canada's largest real estate investment trust, and that one's owned by Loblaws. So the grocery chain that also owns the grocery stores themselves. So RioCan is more of a pure play on commercial real estate, and they come in at a market cap of just under $5 billion. Now, looking at the stock chart, you can see that this stock has dropped about 50% from its pre-pandemic levels. So this is interesting because if you know anything about dividend investing, the more the price of a stock drops, the higher the dividend yield goes. Now, RioCan now trades at about a 10% dividend yield, and they paid their dividends monthly. Now, don't get confused. This 10% yield is an annualized number, which means that for every $100 you invest in RioCan, they're going to pay you $10 over the course of a year, and they just split it into monthly payments. So for example, if you put $100 into RioCan stock, you're going to get $10 over the course of a year at current rates, and they're just going to split it into 12 equal payments and pay you monthly. So it's not like you're making 10% per month. So don't get confused on that part. Now, this is interesting because the price of RioCan shares has fallen to just about the same levels as the height of the Great Recession back in March 2009. So if you look at this chart right here, back in March of 2009, the stock was trading at about $12 per share. Now it is trading about $13 and $13.50, around there somewhere at the time of this recording. And it's on the downtrend, so it might fall more in the near future. So it's trading right around the height of its lows in quite a while. Now, of course, the reason for this, you guys already know. I don't have to spell it out for you guys. You guys know of the current crisis that's going on, and it's hit commercial real estate especially hard as stores are forced to close and people are lagging on their rent. So RioCan is the landlord that owns the land, and they rent out the space to different retailers. Now, RioCan stock is going to drop, of course, as a result, just because if you think about it, if they can't pay rent, then RioCan's revenue is going to drop and they're just making a lot less than what they were making before. But the silver lining for RioCan, and why I like RioCan in particular, is because 75% of their tenants are actually essential services. So I'm talking about places like grocery stores or otherwise stores that are allowed to remain open during this crisis. So 75% of their revenue is somewhat safe, I would imagine, because the stores are continue operating. And from the reports we've seen that the grocery store sales are through the roof. So anybody who's working in grocery for the past few months can tell you that the sales are just through the roof, right? Everyone's rushing to the grocery store and everyone's panic buying these like toilet paper and stuff like that, right? So grocery store sales are skyrocketing, and I don't think that grocery stores will be lagging on their rent anytime soon. So I think that that's the reason why I like RioCan, is that they own a lot of the land that these grocery stores are built upon. Now, looking at the current ratio and debt levels, it might be kind of concerning if you don't know anything about the real estate industry, because the current ratio is kind of bad and the debt is kind of high. But keep in mind that this is an industry that's typically very high in debt, and typically they have really bad current ratios. So I'll say the same thing about RioCan as I said about airlines, is that if you're looking for a company with a good current ratio, you should look elsewhere. You shouldn't look at real estate, or you shouldn't look at airlines even, because they're going to have terrible current ratios. So if you're looking for a current ratio that's good, move along. Now, maybe to settle some of your fears surrounding the debt levels, you can dive into the Q1 2020 report, which if it's too long and you didn't read it, I'll read it for you, right? So I've read it for you, and here are some of the results and highlights that I wanted to point out. So from their Q1 reports, you can see that they have over $1 billion in liquidity. Now, don't get confused. This is not to say that they have $1 billion in cash lying around. This just means that they have $1 billion in credit that they have immediate access to, that they can draw upon if something bad happens. So an analogy is that imagine if you had $1 billion credit card limit on your credit card. It's not that you have $1 billion, it's just that if something bad happens and you need to spend money, you have that $1 billion room to draw upon. You have that credit available to you, so you can draw upon it anytime you want and be able to use that to pay an emergency. Now, moving along on the report, you can see the top 30 tenants that are listed on RioCan's Q1 report, and you can see that most of the top 30 are actually stores that are allowed to remain open. I know some of you aren't Canadians, so you probably won't recognize a lot of these brands, but the ones that I've blacked out, the ones that I've striked out, are the ones that are not really that essential, that's probably closed, or I haven't had the chance to like check each and every one of them. But I think that, you know, for grocery stores like, I don't know, Metro and things like that, that's if you see Metro, that's a grocery store. So for grocery stores, they're obviously allowed to remain open. And I know a lot of services and stores that are not necessarily groceries are still allowed to remain open as well. So I heard a while ago EB Games actually got in some trouble for declaring themselves an essential service and forcing the government to allow them to remain open. Now EB Games is the Canadian version of GameStop, by the way. So whether or not EB Games is allowed to remain open is up for debate. Personally, I think not, but you know, with the amount of money that they're cheating out of their employees, maybe they could pay their rent. Anyways, if you're a GameStop corporate executive, be sure to smash that dislike button. Moving on, we can see that RioCan actually has some of the lowest debt rates that I've ever seen in just any company. So looking at the debt rates, their debt rates are anywhere between 2 to 4% in terms of their bonds and the floating interest rates that they have to pay on their other debts. Now, this is very encouraging to me as a shareholder, just because I think that 2 to 4% is very low, and they should be able to pay that no problem. Compare this to CCL. So if you remember, we did a video on Carnival Cruise a while back, and we did a video about Carnival Cruise raising more money and issuing bonds at, I think it was 11.5% or something like that. Now, 11.5% is incredibly high in terms of bonds, right? And if you look at how much RioCan is paying on their bonds, is only like 2.35%, if I remember correctly. Now, compare that to 11.5%, that's just like a night and day difference, right? It's not even close. So RioCan is getting pretty much free money because, you know, inflation's maybe like 2% in the long term. And with the way that the governments around the world of both Canada and the US are printing money, inflation might go up in the future. So I think that the fact that RioCan has a 2.35% bond interest payment, then that's just essentially free money. It's free real estate. And lastly, if you look at the statement by the CEO, Edward Sunshine, great name, by the way. If you look at the statement by the CEO, he sounded very optimistic, and he stated that this was a strong quarter. Now, the fact that they're able to use language like that implies to me that they're not about to cut the dividend. I mean, it would be really snake if they said, we had a really strong quarter, and then the next quarter they cut the dividend. So I think that in the short term, the dividend might be safe for at least the very near term. Yeah, come to think of it, it might be kind of embarrassing and kind of snake if they did that, right? They cut the dividend. It'll be like, we had a strong quarter, next day, dividend cut. And now if this crisis drags on for longer, let's say it drags on for a year or 2 years, then maybe I'd be slightly concerned. But I think in the short term, the dividend is relatively safe, or as safe as you can get with something that yields 10%. And I'll be buying more shares if the price goes down even more and as the yield gets better. But all of this is, of course, just my opinion. Please make your own decisions as to whether or not you want to invest in RioCan or put your money elsewhere. I mean, you might not want to put too much money in the stock market right now just because of the general trend of the stock market, right? So if you see lately, we've had such a great increase in the stock price of the S&P 500, Dow, especially the NASDAQ. And I'm just thinking that maybe we are getting to a level where it's becoming a little bit unsustainable, right? I think the fundamentals, if you look at the numbers of the unemployment that's coming out and things like that, the GDP decline and things like that, is really not good fundamentals. And I think that we might be due for a major correction in the near term. So I'm not deploying too much capital, but when I see a great deal like RioCan and things like that, I think that it could be a great idea to maybe average down on some of my shares and just start building up a position as well. So maybe do buy stocks if you see good deals, but I would be cautious here. So don't pour all your money, and I'm still pretty cash heavy at the moment right now. So I'll be ready for a stock market crash if one does occur. Anyways, I'll leave this video here. Be sure to give a like if you enjoyed the video and consider subscribing if you like this series. Be sure to follow me on Twitter and Instagram. Links down below in the description as always. And with that being said, I'll see you guys in the next video. Bye-bye.